Yesterday, you mentioned that you read this really in-depth article. Can you give a little highlight about the financial levers of shelter in the U.S.?
Oh, yeah, that was interesting.
Yeah.
And, a lot of, anybody that goes to purchase a home anywhere in the U.S., the primary thing that comes to mind is the mortgage.
Right, that's the biggest chunk.
The biggest chunk
committing
is your principal and interest, and the driving factor of that is your down payment. What's the mortgage rate? What concessions are you going to get? Are you going to pay down your interest? Everything that goes into paying the mortgage is usually top of mind when somebody buys a house. But the article went into more depth. That was the first lever of the financial consideration in buying a house. The second lever, which the article discussed, is part of your mortgage. It's the taxes and insurance.
Okay.
So when you look at your statement, you have a PITI, which is principal, interest, taxes, and insurance.
Right, and most people have an escrow account that houses that, so you're making monthly payments towards it, but the person or the mortgage company that's holding it then usually makes a one-time payment both to the insurance and to the taxes. Sometimes insurance is 2 times a year at the 6-month point, but basically they take care of the actual payment. You just make payments to the mortgage company and they put aside some in that escrow.
Exactly. So the typical homeowner pays their monthly mortgage bill, and in that the mortgage company, whoever you use, is taking a reserve. So if let's say your taxes are $2,400 a year, just as an example, $200 a month is being taken out of your mortgage payment, put into an escrow fund, escrow account, and then the mortgage company pays those taxes on your behalf
whenever they're
due. Same thing with insurance. A portion of your mortgage company is being held in escrow.
Or your mortgage payment.
Yes, held in escrow, and the title company or mortgage company will pay that tax bill because basically they want to go insured. If something happens to your house, they're the one that loans you the money. They want to make sure you have insurance on that house.
Yeah.
But this particular article delved a little bit deeper into, I guess, how you look at a purchase from a homeowner's perspective.
Okay.
The first part being the principal and interest is more of a fixed cost because you know ahead of time the amount of money that's being paid for the property, the amount of interest you're paying for that loan, and so that is kind of a fixed cost, whether you're doing 15-year, 25-year, 30-year mortgage.
Yeah, and you know that up front when you actually purchase the home, you know what you put down, you know what your mortgage payment's going to be.
You're going eyes open into the transaction.
Right, okay.
The two other levers, you're not really eyes open into that portion of the cost, and that is going to slowly or quickly creep up on you. That second lever is the taxes. And the taxes are going to vary depending on what state you live in, what county, what city you live in, because it's not a federal tax situation. It is more a municipal or local tax. I know in our county, the taxes seem to go up every year. The taxes go to pay the firemen, the teachers, supposedly fill the potholes in our roads, pay for the parks, the infrastructure. So the tax base is local, and those taxes are going to go up invariably. The other thing that I had not considered until I looked at this article was because of the commercial properties in our area that are going unfilled.
Yeah, they're just sitting empty. And I don't know if you guys have this in your area, but if you look around, it's amazing how many strip shopping centers, strip malls, in some cases, actual malls,
warehouses,
buildings, warehouses. You see new ones coming up, but there are so many that are just sitting empty, just has a for lease sign on it, and there's not anybody there for years.
Yeah.
So yeah, that also has a huge impact on the taxes.
It has an impact because
and the community.
The local tax authorities are not getting the same revenue from those vacant commercial buildings. They still need the revenue. They still need to fill the potholes, pay the police, pay the teachers. They still need the revenue. But if they're not collecting that revenue base from the commercial arm of property, that is being moved over to the residential arm.
Now, one question with that. Just because a property is empty doesn't mean that there's not an owner of the property. And would that owner still be responsible for paying on that property?
They are, but I believe that they get a break, at least in our area. It may not be in your area, but they get a break if it's not being utilized. So their tax base is lower,
significantly lower,
for an empty building than it is for a building that's actually being utilized. Because if there was a renter in that commercial space, there's more revenue being generated,
So you have
and the
more taxes.
local tax authorities being able to tap into that. So
Okay, fair.
a little nuance there with the commercial property.
So the three levers you're talking about.
Well, the third lever is, and that's uncontrollable from the person buying the house.
Sure.
You know what your mortgage is going to be based on your principal and your interest. Very easy to calculate. It doesn't change unless you refi, but it's good for the life of the loan.
Mhm.
The taxes are going to fluctuate, and they're probably going to go up every year. So when you go into making that initial purchase, for instance, on a 30-year mortgage, you don't know up front what the taxes are going to be 10 years down the road,
Right.
8 years down the road. The third lever is the insurance lever. And the insurance, at least in the state of Texas, and from what I read, California and Florida, the insurance, I mean, depending on where you're at, it's 30% more than it was a year ago. Some places it's 50 to 60% more than it was 2 years ago. Your insurance bill is going up. So instead of, in our previous example, you're paying $2,400 a year for insurance, now you may be paying $4,800 a year for insurance. So the mortgage company is going to come back to you and say, your escrow is insufficient. We're needing to increase your insurance portion to
Which then
$400 a
increases your
month
monthly payment.
instead of $200 a month. And you look at your mortgage bill and you're like, good grief, when I bought this house, I thought I was going to be paying $1,800 a month. I'm now paying $2,600 a month because the taxes have gone up, the insurance has gone up. So it was just a very interesting article. The things you can control when you're looking for a home, what you can qualify for, what your monthly outgo within your budget is going to be, and then you get surprised with the other two levers.
Down the road, potentially.
Your taxes go up, your insurance goes up, your wages haven't increased proportionally to cover
It might
that.
be a good idea in your area, and for those homeowners that are out there that just want to know, you might want to check with your city, county to see what is the cap on the increase per year, because there usually is a cap, so you can anticipate, worst case scenario at least, to see if it increases, this is what it might increase by.
That's the
on
property
the
tax portion.
Tax portion. On the insurance, I don't know that I don't know how they calculate that other than the rebuild value, so the material value and all of that
Yeah,
is
and,
variable.
and depending on where you live in the U.S., even in various states, some municipalities allow your property to be reassessed on a yearly basis. Some are every 2 years, some every 3 years.
Right.
So that is a trailing expense. You go a full year or a full 3 years, and then all of a sudden the tax base increases and your taxes go up.
The biggest thing is, just awareness. As long as you're aware, you can maybe plan better when you're looking at buying a home and making that large investment with you and your family, that you take into consideration not only that mortgage payment, but what is that escrow going to be and how much can it really vary year over year, to verify that you're actually holding on to the income you need to, and building that savings in the event that it does increase, which we of course have seen ours increase over the years.
And a caveat is it doesn't just affect people that are purchasing a home to live in. Even if you're a renter, the second two levers are going to affect you as a renter. The taxes have to be paid. So whoever owns it, the landlord, is paying more taxes, and insurance costs are going to go up. And who pays that? The person that owns the property.
Yeah, but the renter is
insurance.
going to be passed on.
It's going to be passed on to the renter because the landlord has got to pay those bills, and the landlord is not doing this for free. The landlord is going to want a return on investment. And most landlords, at least in the Texas area, they're not getting rich. They're making maybe 6 to 8% return on investment. So they've got all this money tied up into the property. They still have to pay the principal and interest. They've got to pay the taxes that are rising. They've got to pay the insurance that is going up on the piece of the property that you're living in.
And maintenance.
And the maintenance.
Yeah, all the other
upkeep. When it's all said and done, they're making maybe a 6 to 8% return on investment.
Yeah.
So, this affects everyone that has shelter to live in, regardless of the state. The one last point I want to make before we leave is the two of those levers, the tax assessment and the insurance. I was surprised how much they vary by where you live in the country. Mm-hmm. You would think that, taxes are pretty much generic, but there are some states where the tax rate is incredibly low.
But it's probably states that have state tax. So the property taxes can be lower. In Texas, our property taxes are very high, but we don't have a state.
Right, we don't have a state income tax.
So,
and the insurance rates are going to vary depending on where in the country you live.
Which I guess Texas is kind of one of the higher ones.
Texas,
for
I was surprised was higher, but it's due to the recent floodings that we've had the last 2 or 3 years, and the fact that we have a lot of hailstorms, a lot of roofs being replaced.
Would you say the insurance, generally speaking, is increased based on the number of claims in a given area?
Gosh, yeah, absolutely.
Because they have to also offset some of that to cover
absolutely.
claims.
California fires, with $1 million homes, Florida with the storms that come through there, Texas with the storms and the flooding. It appears, and if you're interested, I'll give you the breakdown, or you can Google it or Chat-GPT it. But there's some states that are historically very low in the claims that are paid, and so the insurance rates reflect the fact that the rates are not going to go up as quickly or go up as much because the insurance companies do not pay a lot of claims in those particular areas.
Or if they do go up, it's to offset other states that that same company insures. Yeah. I'm sure it affects everybody
really
a little bit.
I'm going to get off on a tangent here. What really irritates me about insurance is they charge you based on the replacement value. And I've argued with our insurance company countless times. Of course, I don't win, they win. The replacement value with a total destruction, you still have the land, which doesn't have to be replaced.
Well, and how, realistically, how would you replace that? I mean, that's a little silly that they have that in as part of the coverage, but most people don't consider or look at that.
You don't have to replace the land, and typically, if you're going to rebuild like kind, you've got the concrete pad. If you have a concrete foundation, they don't have to replace the concrete pad.
If you have a slab house versus a pier and beam, the slab is generally it's going to survive, a fire, maybe not an earthquake if it cracks up, but it'd have to be a really bad earthquake to crack it up.
And the third thing, which is always on our insurance bill, is an outbuilding, which is valued at 10% of whatever your main structure is.
And what is an outbuilding?
And we have no outbuilding. And most homes in our neighborhood have no outbuilding, but they're going to increase the rebuild value 10% based on an outbuilding.
So they will build an outbuilding for you?
No, they're only going to replace all the damage, but they're putting an outbuilding at 10% of your main structure in addition as part of the rebuild value.
I didn't know that. I didn't know that. But I wonder what an outbuilding is, and is it something that we could put on our property and our insurance would not go up if we added something?
Maybe I should probably ask that in the next phone call with them. But yeah, I get a 10% premium for an outbuilding that doesn't exist, and I have to pay insurance on that.
Now, okay, so depending on the insurance you have, what have you looked at it in this level of detail? Number one, and second, does it actually break out an outbuilding as part of a rebuild value, and does it include your land as part of the rebuild value? Even though, again, if you have the land, you have the land. It's not something that needs to be rebuilt, and I really don't understand what that means. It's not a foundation rebuild; it is actually land. So I don't know how you would even.
It's all inclusive in the cost. So if you have, let's say, a $500,000 house assessed value, your insurance is going to be very close to that assessed value. Even though if you had total destruction, the insurance company is not going to be on the hook for $500,000. They're going to be on the hook to replace or rebuild the house that was destroyed.
What was existing.
And most insurance claims are not a total rebuild. Now, besides the Palisades fires and the Florida, total destructions, you don't have a total rebuild. I mean, we redid our roof, 2 years ago? We paid our deductible. Not a total rebuild. We redid the roof. We had a leak a few years ago downstairs with one of the water heaters. It was like a $4,500 claim. We paid the deductible. So we're paying insurance on a total rebuild, including an outbuilding that we don't have and land that doesn't have to be rebuilt. But
we still have to pay insurance on it.
Anyway, I went down a rabbit hole here. The three financial levers of shelter ownership, or shelter: your mortgage, which includes the mortgage piece, which includes your principal and interest, you have control over. The taxes, you don't have any control over. They're going to go up either yearly, 2 years, every 3 years.
And
the third
just
lever
real
is
quick,
the insurance.
On the taxes also, most counties will allow you to contest the taxes if you want to try to lower them or freeze them, or to lower them, number one. And if they lower them or keep them the same, you can actually request that they freeze them for 2 years. So, but it depends on the county that you're in. So check with that. You should get a letter in the mail that says, here's what your assessed taxes are going to be. If you want to contest it, this is your time frame to do so. And then you can either do it, or there's a lot of little companies out there that will do it on your behalf for some percentage.
Yep.
So yeah, you've got a couple of options there if you wanted to. And then yes, the third would be the insurance portion. That's an unknown, a variable factor.
A variable factor
to consider.
So if you're looking to purchase property, consider the three levers when you go in. Don't max out because you think you can afford something and you're forgetting about the taxes and the insurance. It's going to increase. If you're a renter and you get upset because
your rent went
up $30 a year or a month, keep in mind that the landlord is probably got a bigger tax bill and a bigger insurance bill.
Yeah, and that's, you hear about rent going up for renters out there, that usually every 1 to 2 years that the rent usually goes up. That's probably why, is they probably have more costs now with the taxes, insurance. Maybe there's other factors that go into that. But that is probably why it's going up. I know nobody likes that, but
Nobody likes it.
we
but
got to cover costs.
If you've got any real world experience or comments or questions, or you'd like access to the article, I thought it was a very good article. It breaks down all 50 states where these things are better or worse.
I'll try to go back and see if I can just link it, and I'll just add it into the comments to this video. And then if for those that are interested, you want to see the full kind of breakout across the different states, you can take a look at that for your particular state.
Absolutely. Well, thanks for joining us.
Yeah, and don't forget to like, follow,
and share.